Hello and welcome. In the world of investing, few topics are as intriguing and intimidating as options trading. You've probably heard the stories, the legendary gains and the catastrophic losses. It's often portrayed as a high-stakes casino, reserved only for Wall Street pros and reckless gamblers. But what if I told you that at its core, options trading is just about one thing: managing risk and opportunity? It's a tool. And like any powerful tool, whether it's a chainsaw or a surgical scalpel, it can be incredibly useful in the right hands, and incredibly dangerous if you don't know what you're redoing. This video is not a guide to getting rich quick. This is a beginner's guide to understanding the tool itself. We're going to demystify the fundamental concepts of calls and puts, explain the very real risks in plain English, and show you the practical, sensible ways beginners can think about using options. So, let's sharpen your knowledge before you even consider touching the tool. Let's start with the absolute basics. What is an option? In simple terms, an option is a financial contract that gives you the right, but not the obligation, to buy or sell an asset, like a stock, at a specific price, on or before a specific date. Think of it like this. Imagine you reconsidering buying a house listed for $500,000, but you need a month to get your financing in order. You don't want to lose the house, so you pay the seller $5,000 for an option contract. This contract gives you the right to buy the house for $500,000 at any time in the next month. What happens next? Well, if the house's value suddenly jumps to $600,000, you can exercise your option. You buy it for the agreed-upon price of $500,000, making an instant $95,000 profit, minus the $5,000 fee you paid. On the other hand, if the house's value drops or you simply change your mind, you can just walk away. You are not obligated to buy it. Your only loss is the $5,000 fee you paid for the option. This is the essence of an option. It's a form of leverage and insurance. Now, let us apply this concept to the stock market with the two main types of options, calls and puts. First up, a call option. A call gives you the right to buy a stock at a specific price. When you buy a call, you are making a bet that the stock price will go up significantly before the option expires. Let's use a real example. Imagine Apple stock is currently trading at $150 per share. You believe it's going to rise to $180 in the next month. Now, instead of buying 100 shares for a hefty $15,000, you could buy one call option contract, which controls 100 shares. Let's say it has a strike price of $155 and expires in 1 month. This option might cost you $3 per share, or $300 total for the contract. So, what happens? If Apple stock rises to $180, you can exercise your right to buy 100 shares at $155 each. You could then immediately sell them on the open market for $180, pocketing a $25 per share profit. After subtracting your $3 cost, your net profit is $22 per share, or $2,000 to $100. That's a massive return on your $300 investment, but here's the catch. If Apple stock stays below $155, the option expires worthless. You lose your entire $300 investment. This is the key risk of buying calls. Now let's talk about the other side of the coin, a put option. A put option gives you the right to sell a stock at a specific price. When you buy a put, you are betting that the stock price will go down significantly. It can act as insurance for your portfolio or as a way to profit from a decline. Let's say you own 100 shares of Tesla, currently trading at $200 per share. You're worried about a potential drop over the next quarter. You don't want to sell your shares, but you want some protection. You could buy a put option with a $190 strike price, expiring in 3 months, for $5 per share, or $500 total. If Tesla crashes to $150, you can exercise your right to sell your 100 shares for $190 each, even though they're only worth $150 on the market. This effectively limits your loss, but what if Tesla stays above $190? In that case, the put expires worthless, and you're out the $500 premium, but you still own your shares, which have hopefully held their value or even gone up. Think of that $500 as an insurance premium you paid for peace of mind. Okay, so understanding calls and puts is the easy part. But understanding the risks and the psychology is what separates informed investors from those who get wrecked. Let's get into the crucial reality check. The first and most important risk you need to understand is time decay, also known as theta. An option is what's called a wasting asset. Its value has two components: intrinsic value, which is the real profit if you exercised it right now, and time value, which is the potential for future profit. Every single day that passes, the time value evaporates. This process is called time decay, and as an option bear, it is your number one enemy. If the stock doesn't move in your direction quickly enough, your option will lose value even if you're eventually right about the direction. The second reality check is that the odds are stacked against you. The brutal truth is that approximately 90% of options buyers lose money. The math of time decay, combined with the need to be right about the stock's direction, its magnitude of movement, and the timing of that move, makes it an incredibly difficult game to win consistently. So, what's a safe path for a beginner? How can you dip your toes in without getting burned? The key is to start by thinking of yourself as a renter, not an owner of the option. Better yet, start as the one who collects the rent. This brings us to a couple of more conservative strategies. First, there's the covered call strategy. This is one of the most popular and conservative approaches. If you already own at least 100 shares of a stock, you can sell or write a call option against those shares. You collect the premium upfront, which is like earning rent on your stock. If the stock stays below the strike price by expiration, you keep the premium and you keep your shares. If the stock price rises above the strike price and gets called away, you simply sell your shares at that higher price, locking in a profit. It's a great way to generate income from stocks you already own. Another conservative strategy is the cash-secured put. With this strategy, you sell a put option on a stock you'd like to own, but only at a lower price than it's currently trading. You collect the premium upfront. If the stock stays above your strike price, you just keep the premium. If it falls below, you are obligated to buy the shares, but you get them at your desired lower price, minus the premium you already collected. With both of these strategies, you are the seller of the option. This means the powerful force of time decay, that enemy of the bear, is now working in your favor. You are collecting the premium that is slowly decaying away. So, a final word of wisdom to wrap all of this up. What are options? Calls are the right to buy, essentially a bet that the price will go up. Puts are the right to sell, which is a bet on the price going down or a way to get insurance on your stock. The number one rule for beginners is this: never risk more than you are willing to lose 100% of. Buying options is a high-risk, low-probability game. For a smart start, consider conservative, income-generating strategies like covered calls or cash-secured puts if you decide to use options at all. Remember, options are not a lottery ticket. They are a complex financial derivative designed for sophisticated risk management. For 99% of investors, a simple portfolio of low-cost index funds is the best and most reliable path to building wealth. But if you choose to explore the world of options, please do so with extreme caution. Use extensive paper trading to practice, and only ever risk a very, very small portion of your capital. Knowledge is your best hedge against risk, and now you have a little more of it. Thanks for watching, and be sure to subscribe for more content to help you become a smarter investor.